Good afternoon, everyone. Welcome to this session on HDFC MF Year Book 2023, Decoding the Year Ahead. And I have here with me Chirag Setalvad, who's Head Equities at HDFC AMC. Myself, Ram Kumar, I'll be the moderator for this call. The last few years have thrown in a lot of surprises for the global economy and markets, including the COVID pandemic, the war in Ukraine and Russia, and more recently, the unprecedented pace at which the monetary tightening that has been carried out globally, led by the US Fed. Well, all these series of events have impacted the global economy and markets in a major way. But fortunately for us, the Indian economy sailed through most of these challenges in a great way. And we now stand out, our economy now stands out as a shining example of resilience. And for this reason, we have titled our yearbook, this year's edition of yearbook, as Indian Economy and Oasis in the Desert. While most of the discussion today predominantly will be on this theme, Chirag is here to decode the challenges and opportunities as we have stepped into the new year. And he'll be covering the economies, the global economy and Indian markets, evaluations, and so on. So with that, I invite Chirag, the floor is yours. And post his initial session, we can have the Q&A. So if there are any questions, you can type out the questions in the chat window and we'll take them up in the end. Over to you, Chirag.
Thank you, Ram. And thank you, everybody, for joining this call today. Wishing everybody a very happy and prosperous new year ahead. So let me give you a brief introduction in terms of how we will take this forward. So we have about 40 minutes to make a presentation and then about 20 minutes for Q&A. So the yearbook is essentially broken into two parts. One is, of course, it is a look back at the year gone by and how have asset classes behaved, how have Indian equities behaved, how has the global and Indian economy behaved. And a little bit in terms, the second part is a little bit in terms of the outlook going forward. And I think possibly we'll spend a little bit more time on the outlook during the Q&A session. So let me start with how the year gone by has been. So the year 2022 has clearly been a challenging year across asset classes. And in that sense, it's a year which can be easily forgotten. Whether it is Bitcoin, NASDAQ, commodities, MSCI World, and so on, across asset classes, returns have been poor. And when you look at equities from an MSCI World perspective, so that is global equities in 2022 corrected by about 16%. The outliers really have been the agri index, oil, and the dollar, which have all performed in a positive fashion. Otherwise, across asset classes, because of rising interest rates, because of rising inflation, growth concerns, and a rollback of monetary stimulus, you've seen a meaningful correction across asset classes. When you move across to equities, the story is no different. Equities in general have done poorly. And across the board, you can see on the right-hand side, what we observe is emerging markets have actually done a little bit poorer than developed markets. But across the board, whether it is in Europe, US, India is an exception, but across Asia, Americas, returns have been negative. The few examples of positive returns are India, Jakarta, and FTSE. And what is interesting is, at least as far as India and Indonesia go, is these are very domestic-centered economies. So in a year in which equities has given an average negative return of 16%, the Nifty has actually eked out a positive return in rupee terms of about 4%, and the return for Indonesia is a similar 4%. So India, in that sense, has done well. Both these economies are domestically oriented. Both these economies have fared relatively much better, and hence you see both these markets have performed reasonably well. Currencies, clearly this has been the year of the dollar, and you've seen across countries, the dollar has performed admirably, and barring a few exceptions, the dollar has outperformed by an average of 7 to 8% across major currencies, whether it is in Japan or Europe or China or Canada or India. With the exception of Russia and Brazil, which are both commodity-centric economies. I think those have fared a little bit better, but barring that, the US dollar has actually fared extremely well. So when you put that in context a little bit, if you remember the slide 2 slides back, which is the Nifty has given a positive return of about 4%. But again, when you look at it from a dollar perspective, actually the return has been a negative 7% because the rupee has depreciated by 11% last year. Now, this has been an extremely interesting year for commodities because the year prior to this, we saw a huge jump up in commodities. And this huge jump up in commodities led to a spike in inflation, which of course later on led to a spike in interest rates and led to a slowdown and so on and so forth. And the spike in commodities was driven by 2 or 3 things. On one hand, post-COVID, the initial expectation was that demand will come back slowly, but demand came back much faster than was anticipated. At the same time, supply came back much slower than what we thought it would. And this was driven by supply constraints across the world, logistic constraints, lack of availability of manpower, and so on. And hence, while demand came back very quickly, supply was constrained, and that led to a sharp jump in commodity prices. Over and above that, we also saw there was a tremendous amount of liquidity which was injected in the system around COVID to support economies. And that liquidity not only went into the real economy, that liquidity also went into speculation across asset classes, across equities, across fixed income, and of course in commodities as well. So that was the third factor. So there was strong demand, there was weak supply, there was a resurgence in liquidity. And over and above that, we saw China following a zero COVID policy. And because of that, and China being the manufacturing capital of the world, we saw constant start and stop. And that too exacerbated the supply situation further. On top of all of this, we had the Russia-Ukraine war, which resulted in a sharp spike in energy prices. So we saw a sharp jump in coal prices, we saw a sharp jump in gas and energy prices because of the Russia-Ukraine war. Also, commodity prices, as far as agri prices, jumped sharply because of the Russia-Ukraine war. So really, from that perspective, 2021, the year before, was a perfect storm in commodities. Whatever could go wrong, in a sense, went wrong. Demand came back, supply was constrained, liquidity was injected, Russia-Ukraine, an event risk played out. And we also saw this China zero COVID policy take place. All of this resulted in a huge spike in commodity prices. Now, as inflation surged across the world, central banks reacted, albeit a little bit slowly, driving interest rates higher. It has resulted in a fiscal tightening, it's resulted in a monetary tightening, and demand now is correcting. So all the factors which have pushed up commodity prices are now seem to be reversing. So demand, which was doing extremely well post-COVID, is now correcting and correcting quite meaningfully. And a large number of economies, in fact, are expected to go into some form of recession. And certainly most economies are going through a slowdown. So demand is correcting. Supply, which was constrained, is also coming back in a substantial fashion. And we now see logistics costs, which had spiked very sharply during COVID, have now come back to pre-COVID levels. And the supply constraints related to manpower and semiconductors and so on and so forth also seem to be normalizing. So supply seems to be correcting. The Russia-Ukraine war, while it continues, the impact of Russia-Ukraine from a commodity standpoint has also normalized. Prior to the war, Russia was producing roughly 10 million barrels a day of oil. That has gone back to that level of 10 million barrels. The only difference is earlier, Russia sold predominantly to the West and to Europe, and now it sells predominantly to India and to China. But we are back to the same level of production that we saw prior to the Ukraine war. So in that sense, that has also reversed. And finally, the China zero COVID policy, as you are all aware, has also now finally been changed. And we expect, well, the first sort of 3, 4, 5 months will certainly be challenging. After that, we expect there will be a bounce back in Chinese production and demand as well. And so in a sense, the things which are all contributed to commodity prices moving up are now contributing to commodity prices correcting. And so what we've shown here on the bottom left-hand chart is how commodity prices have moved during the year. And you can see across most commodities, there's been a sharp correction. But a little more interesting is when you look at the chart on the bottom right-hand side, and look at how much prices have corrected from the peak. So whether it is aluminum at 40% or zinc at 35 and iron ore at 28 and so on and so forth, there's been a meaningful correction in commodity prices. Now, I'm trying to spend a little bit of time on this because this is important. Because as commodity prices correct, the pressure on inflation and hence the pressure on interest rates will also tend to abate over a period of time. And in fact, the thinking that we have is over the next year or so, the debate is going to shift. Right now, the debate is focused largely on inflation and interest rates. And going forward, with the correction in commodity prices, food prices, fertilizer prices, transportation costs, and so on, the debate is going to soon shift away from inflation to growth. Growth has slowed down, and it is still unclear whether large economies like the US and Europe and so on, whether they'll see a soft landing or a hard landing. But the fact of the matter is that growth will slow down quite meaningfully. In that context, again, India stands out. So before we get to the India piece, let us talk a little bit in terms of the global economy. And what you see on the top most chart here is how economies are likely to fare in 2023 compared to 22. So the world, which was growing at about 3.5%, growth is likely to dip to 2.5%. And within that, emerging markets are actually holding on relatively better. It is really advanced economies which are seeing a sharper slowdown, almost halving of growth from about 2% or 2.5% to about 1%. And it is interesting that we injected so much liquidity into the system during COVID, and now that liquidity is getting sucked out. And fiscal deficits, which had peaked at 7% and 9% in calendar year 2020, are expected to dip back to previous levels of closer to 2 to 3% over the next couple of years and go back to where they were historically. Debt, which is also ballooned in the COVID years, is also expected to come back to more normal levels. The relatively emerging market debt continues to be higher. There are several headwinds to growth, and these are, I think, spoken about quite often, so I'll spend a little bit less time on it. But inflation has gone up very, very substantially. And I think the interesting thing about inflation is, inflation across major economies today is 7 to 8%. Now, 2 points on this. The first is, while global economies have not adjusted and have not experienced this level of inflation for many years, India as an economy has encountered 6 to 7% very often. In fact, the average inflation in India in the last several decades has averaged 6 to 7%. So 6 to 7% inflation is not a number which is unusual to deal with and is not disruptive from an Indian context. 6 to 7% or 8% is extremely disruptive from a global context because most of these global economies are used to encountering inflation which is closer to 2 to 3%. So inflation rising will certainly bring down growth, and that is already visible. And the question, of course, is will growth come down substantially, or will it be more of a soft landing? And I think the jury is still out on that. But interestingly, India will continue to do well. This year, India's GDP is expected to grow at close to 7%, 6.9. Next year, the expectation is that India will grow at about 6%. And this is in an environment in which Europe will slow down to 1%. America is also expected to slow down to 1%. Europe will, in fact, see 2 quarters, it was expected to see 2 quarters of negative growth, which is what the technical definition of a recession is. So in that sense, India's inflation, so let's look at it from both perspectives. Inflation globally is currently high and is posing challenges, whereas in India, it's a number which is much more digestible. That's the first point. Growth is slowing down globally, as well as in India, but India growth is slowing down by about 1%, whereas globally growth is slowing down much more significantly. But I think it's also important to keep in mind, inflation is the concern of today. I'm not clear whether this is going to be the concern that will continue to prevail because of a correction in commodity prices that we spoke of earlier. The US is an example. US inflation, which peaked at 10%, has now come down to about 6.5%. And the expectation is by the end of this calendar year, and this is a JP Morgan estimate, that inflation will actually cool off to roughly 3.5%. If not a little bit lower than that. So inflation is really, I think, will probably be less of a concern going forward. But the question, while inflation will come down, the question is, will it come down to earlier levels? And our expectation is while inflation will come down, it will remain a little bit elevated compared to historical norms, and hence, and could remain at those levels for a little bit longer because the labor markets, especially in the US, are very tight. And we'll get to that in a later on part of the presentation. Now, we have certain headwinds to growth, which is rise in inflation, rise in policy rates, and a reduction in balance sheets. And I think the last number is quite interesting. The G4 balance sheets are expected to reduce by $2 trillion in CY23. The US is sucking out $80 billion per month. So the US itself will remove close to 800 to 900 billion dollars in CY23. And when liquidity gets sucked out of the system, it tends to impact global markets, all asset classes, and tends to act as a weight on returns. So that was the one side of the story. The other side of the story is we've seen a significant accumulation of savings, which has occurred during the COVID period. And I think this will act as a little bit of a buffer. So that's one good news. The second is unemployment levels in major economies are far lower than what they were pre-pandemic. And in that sense, that also provides a support. The US is an example. The US economy is actually doing fine. In fact, the problem with the US economy is it overheated? It will slow down a little bit, but the labor market there and unemployment at 3.6, 3.7% is still very low compared to historical averages. So we have excess savings, we have unemployment, which is low, and at the same time, household debt, which is the chart right at the bottom, has also come down quite meaningfully. And these are all factors which should support growth from a longer-term perspective. Now, we'll quickly touch upon some of the major economies. Let me start with the US. And what you can see here is US is actually doing quite well. So US goods and services are now above their pre-pandemic levels. Goods recovered faster, but services are also recovered quite nicely. The problem with the US today is largely that the labor market is very tight. Unemployment at 3.7% is a number which the Fed Reserve is not comfortable with. And one of the reasons for the labor market being so tight is a lot of people have left the labor force. And this is what is termed as participation rate. And the reason for that is a lot of people above the age of 55 have chosen to leave their jobs to pursue other interests or to leave the labor force entirely and take an early retirement. And as a result of that, there has been a shortage of labor, and unemployment is extremely low. Growth is moderating, and we are seeing signs of that. It is still in bits and pieces. US economy in general is doing okay, but things are starting to slow down. We are seeing that a little bit in terms of US retail sales. We are certainly seeing that from a housing perspective. So the housing sector has seen a sharp deceleration when you look at new home sales and building permits. And housing is a large segment of the US population, accounts for almost 1/5 of the US population. So as that slows down, certainly it'll have an impact on the overall situation. US inflation, this is what we spoke about earlier. In fact, US inflation is expected by the end of December 24 to get back to closer to target levels of about 2.5%. So as the economy slows, inflation is likely to moderate as well. China, very briefly, we created the slide at the end of the year, and it shows you how quickly things change. There was an expectation that China will abandon its zero COVID policy, and it's done so abruptly, which is quite unusual from a Chinese standpoint, because the Chinese government usually likes to control the fundamentals and narratives very, very closely. But they have chosen to abruptly change zero COVID as an approach, and which means, just like India, just like the rest of the world, the next 6 months are going to be extremely challenging. You'll see a sharp rise in hospitalizations. You'll see a sharp rise in number of deaths, which can already be seen. The data from China tends to be quite unreliable. But 6 months from now, when things stabilize, there is going to be a lot of pent-up demand. And there will be a sharp improvement, not only in demand, but also in manufacturing. And that will put some pressure on commodity prices towards the end of the year. So I think that is something that is worth keeping in mind. Commodity prices have corrected. That's good news for equities. But by the end of the year, as China comes back, it will put some pressure on commodities. It will also be a source of capital. The last 2 years, global FIIs have chosen to ignore China. And they are looking at China a lot more closely now, considering that there is this reopening trade that they can possibly play. The interesting thing is, from a long-term standpoint, China's growth is unlikely to go back to its heady days of 8-9%, and is likely to be significantly lower than that. And there are two big reasons. One is, of course, a little bit more short-term in orientation, which is the Chinese real estate segment. And that segment is very large. Chinese real estate accounts for 40 to 50% of local government funding. And it's a significant form of savings for the Chinese population, and we've seen a sharp deceleration taking place in real estate activity. And I think that will weigh in. So while the recovery in China will happen by the end of the year, it will get moderated to some extent by the real estate segment, which continues to remain under pressure. The other interesting thing is China's demographic advantage is now turning to be a disadvantage. And for some people may have read this article which came out yesterday or day before yesterday, that 2022 was the first year that the Chinese population actually fell. And so we are now seeing the working age population in China is likely to shrink. And when that happens, it's likely to have a large impact on consumption. And of course, as it has an impact on consumption, down the road, it will also have an impact on investments. The euro area, and again, this is interesting because just like the Chinese slide has changed so much, the euro slide in a short period of time has also changed quite a bit. So what we have on the top is a chart which shows energy consumption as a percentage of GDP. And what you can see is the red bar there is how gas as a percentage of the economy, as a percentage of GDP, jumped very sharply. Now, we have seen in the last few months, the last month or so, a very sharp correction in gas prices. So the big concern was obviously the shutoff of gas supply from Russia and the fear that the winter could be a poor one, and hence oil prices jumped sharply. And as luck would have it, the winter in Europe was much milder than anticipated, and hence demand came down, storage went up, and today, shockingly, gas prices are lower or pretty close to what they were prior to the Russia-Ukraine war. So in that sense, the pressure which was there on inflation from a commodity perspective, from a gas perspective, is easing out quite significantly. So far, Europe has been facing a lot of pressure from inflation. And due to that inflation pressure, we have seen a sharp slowdown, which is what you see on the bottom right-hand chart. Industrial production, retail sales, all of that slowing down. Now, going forward, the situation changes a little bit or quite a bit because energy prices have corrected, and hence the pressure from an inflation standpoint comes down. Food prices, fertilizer prices, all of that has corrected meaningfully. And hence, going forward, we think that the pressure on growth will tend to ease a little bit. And this is one of the reasons why the view on Europe has changed from an expectation of or a reasonable probability of a hard landing has now moved in a 6-month period to what is expected to be a soft landing, both in Europe as well as in the US. But I think the Europe narrative has changed even more than the US. The US was always expected to have a soft landing because the US did not face issues related to consumption, related to energy. But now with the energy situation changing, even Europe is expected to have much more of a soft landing. So this is what our title slide talks about, India being an oasis in the desert. So India's growth certainly stands out. This is IMF forecast of 6.9% this year and 6.1% next year. So you can see that India really is head and shoulders above everybody else from a growth perspective. Most economies are slowing down and slowing down materially. So just to take the euro area as an example, that growth is slowing down from 3% to 1%. The US is almost halving in growth from 1.6% to 1%. So a 1% slowdown on a base of 7% is obviously a much smaller correction than what you would see if growth is, 2, 3, 4%, which is what you see outside of India. I think there is very few economies which are actually going to see faster growth in 23, and possibly Thailand would be that only economy simply because they've seen a big change in tourism, which is a large proportion of that economy, but it is extremely small. So from a global investor perspective, India stands out. India's growth is significantly higher. India's inflation at 6 to 7% is not unusually higher than other economies. India's political system is a lot more stable. US goes into elections next year. UK will also go into elections shortly. And here, all of a sudden, you have, well, not all of a sudden, but you have India, which is a strong economy, growing well, reasonable inflation, and with political stability. So India certainly stands out from that perspective. So let us briefly talk about the Indian economy, and then we'll move on to equity markets. So before we get into year-to-year growth in India, because this is where a lot of the focus is, what is growth in 22, what is growth in 23, and so on. Let us first take a longer term perspective. Let us look at India's growth over the last 4 decades. So what we have here is decadal growth rate. So we've broken up the last 40 years into 10-year periods. And what is remarkable is that despite all the challenges which we have faced in each of these decades, whether it is related to the dot-com bubble, whether it is related to the Asian crisis or the financial crisis and the oil crisis and so on, we have been peppered with crisis in the last 40 years. Despite that, India's growth has actually been quite consistent at 12%. Roughly half of that comes from real GDP growth, and the other half of that comes from inflation. So despite all the challenges, India continues to grow at a healthy pace of 12-13%. So you ask investors, what is the return expectation that they have? Most investors will turn around and say that we expect roughly 12, 13, 14% in terms of returns. And where does this 12, 13, 14% number, where does it come from? Why do we anchor on 12 and 13 and 14? Why don't we expect 18 and why don't we expect 9? And the reason for it is, at the end of the day, the economy, the stock market is a reflection of company growth. And company growth is a reflection of economic growth. So over a period of time, and of course a longer period of time, if the economy grows at 12 to 13%, then you would expect corporate growth to be similar. In fact, corporate growth will actually be higher because agri, which is the slowest growing part of the economy, is not fully represented in corporate India. So corporate India is obviously much more manufacturing and services. Those are the faster growing parts of the economy. So when the economy grows at 12, 13%, actually corporate growth should be a little bit faster than that, at 13, 14%. And that is why over a longer period of time, equities tends to also give a return of 13 to 15%. Now, for us to capture that growth, it is important that we invest in markets for a long period of time to take care of volatility and to make sure that we don't make one of the two following mistakes. Mistake one is to enter markets significantly when they are expensive. The other error is to exit markets when they're significantly cheap. As long as you don't do either of those two mistakes, what happens is you capture the growth in the middle. You're neither entering too expensive nor you're exiting too cheap. Hence, you capture the growth. And growth economy is at 12%, and corporate needs should be a little bit faster. So there is no reason over an extended time frame why the stock market returns should not reflect overall growth in the economy. So having given you a broader long-term picture, we will now turn to a more narrow or a mid-term perspective. And again, here it's not surprising that the two markets which have done the best are the two markets where average GDP growth over the next 4 years is expected to be the strongest. So India at 6.5% and Indonesia at closer to 5.5% are two of the strongest growing economies. In China, growth is expected to bounce back. India also stands out as a country where the working age population is actually rising. So India has a demographic dividend as opposed to a demographic disadvantage, which is now likely to play out in China. Total debt to GDP in India also is significantly lower than what you would see in other large economies. So there is a chart on the right-hand side. You can see we're significantly below what you see in Japan, in Europe, and US, and so on, in terms of total debt to GDP. This is a very, I won't run through this slide in too much detail, but just to point out a few interesting points. One is we are seeing a big resurgence in manufacturing. And this is led by a variety of reasons, but let me just point out a few. The government has rolled out PLI schemes, and PLI schemes have garnered commitments of 250,000 crores. Now, even if half of those commitment comes in, it's a significant investment. So this is one big change. The second big change that we have seen is a sharp reduction in India's corporate tax rate. Corporate tax rates have fallen from the mid-30s to the mid-20s, and that itself makes India a lot more attractive as a destination. The China plus one story, which has historically been more of a story, is now actually playing out on the ground and this started actually even pre-COVID. During the Trump era, we saw a sharp increase in tariffs, and already globally, boards started to discuss diversification strategies away from China. And COVID has accelerated that trend because of the concentration of manufacturing in China and because of the supply chain challenges that we saw in COVID. There is an increasing conversation in terms of moving away from dependence on China to other economies such as India. And India, of course, gives a tremendous advantage because we're a large country. You can not only make in India and sell outside, but you can also make in India, sell within India. The regulatory environment is turning a lot more positive. So in that sense, we have already seen an improvement in manufacturing, and we think that will continue. Private capex, I think the important point I will point out here is the third one, which is bank balance sheets have improved very, very significantly. So if you go back to 2018 and 19, bank balance sheets were in significant trouble, and gross NPAs had peaked out at about 6-7%. They are now down to 2%. So the balance sheets of banks today are in a far stronger position. That's the first point. The second is capital adequacy, which used to be 12-13%, has now peaked at 14-15-16%. So the bank's balance sheets, once again, are a lot healthier. And growth, which was hovering around 7-8%, has now bounced back to 15-16%. Now, the point of this is banking provides liquidity, which is the lifeblood of an economy. And what we saw in the 17, 18, 19 period was that banks were struggling from a balance sheet perspective. And that situation has changed dramatically. And I think this will also give an impetus not only to overall manufacturing, but specifically to private capex. On infrastructure, I think the government has genuinely done a remarkable job. And the central government in particular, less so the state governments, but the central government has focused significantly on capex, on infrastructure creation, and that is likely to continue. And this is not just a story, this is what we see on the ground. Today, when you look at infra companies, whether it's a road company or a construction company or a capital good company, all of these companies are sitting on order books which are at multi-year highs. So order books are healthy, order terms are very strong, and order inquiries, even today, continue to be very robust, which means that infra and capital good companies are able to pick and choose orders which suit them at terms both from a working capital as well as from a margin perspective, which are beneficial. The last point here is on consumption, and this is a story which has always been there in India, which India has significant potential from a consumption perspective. And this is clearly because there is under-penetration, whichever category you look at. The penetration of consumer products, consumer durables, consumer non-durables in India is very low. So the interesting thing is not only India today stands out not only from a near-term, mid-term standpoint, but also from a long-term standpoint in terms of the outlook. Let us move. So we've spoken quite a bit in terms of the importance of India from a global manufacturing standpoint. So we're not going to get into that in greater detail. So I'm going to skip this slide. We've also spoken about private capex. So let us quickly, in the interest of time, we also want to make sure that we leave 20 odd minutes for Q&A. So we'll move to the more interesting part of the discussion. So we've spoken about economies, global and India, and we'll now move to equity markets. So we'll start with a little bit of a snapshot in terms of how the markets behaved in the year gone by. So Nifty, which is obviously a large cap benchmark, is up about 4.5%. In relation to that, actually the broader market has underperformed. So mid caps are up about 3.5%, and small caps were down about 14%. So large caps certainly better than mid caps and small caps last year. But keep in mind that the two prior years were the years in which the mid caps and small caps did far better. So when you look at 2021, mid caps, small caps did very well. And really 22 has been a normalization in that sense, where the large caps have done better and in that sense have caught up. From a sector standpoint, there have been a handful of sectors which have done particularly well. So we saw utilities did extremely well. That was partly as the valuations of these segments were very cheap. Banking balance sheets improved as growth profile improved. We saw banks, both public sector as well as private sector, do quite well. FMCG is a defensive in general and has tended to underperform in the prior years, and we saw a reasonable performance in 2022. The sectors which performed relatively poor were more outward looking. IT and healthcare, both of which obviously have greater dependence on demand outside of India, saw a reasonably meaningful correction. IT, of course, to keep in mind, while 22 was a poor year, the two prior years to that have been extremely strong. So after two fantastic years, we saw IT correct. So this is on the back of two very strong years, which should also be kept in mind. So now let's get to valuations. And I think this is quite relevant. How do valuations stack up today? Indian markets, reasonable, cheap, expensive. Certainly, we've had a decent run over the last couple of years. Today, when we look at Nifty valuations, we look at the PE multiple. And when we look at forward PE multiples today, the Nifty trades at roughly 18.5, 19 times. This compares with a 10-year average valuation of about 17 times. So the Nifty trades at about a 10% premium to its historical average, a 10-12% premium. So is the Nifty cheap? No. Nifty is typically cheap when it trades at a multiple of 10 to 15 times. Is the Nifty necessarily expensive? Expensive, so 10 to 15 is cheap, 15 to 20 is reasonable, 20 plus 20, 25, 30 tends to be expensive. When markets are cheap, markets are actually very simple to think of. When markets are cheap, you get two sources of returns. You get growth, which tends to be 12 to 15%, but you also get valuations which move up. We are not in that scenario. When markets are reasonable, you get growth. You tend not to get valuations moving up, nor do you get valuations moving down. So your returns tend to gravitate around growth. That's roughly where we are today. When markets are expensive, you still get growth. So you get growth in all three environments, cheap, reasonable, and expensive. But when markets are expensive, that growth gets compromised or diluted by valuations moving down because the markets are expensive to start with. So at 18.5, roughly at 18.5 times at a 10% expensive valuation, we think we're somewhere in the middle. We don't think that markets are cheap, but nor do we think that markets are expensive. And returns should be broadly in line with historical returns, possibly about 1% lower. So if you look at the market being 10% more expensive, and if you're investing for a 5-7 year period, you need to adjust your return expectations down by about 1 to 1.5%. It is still a reasonable return from an equity standpoint. When you look at valuations from a sector perspective, and this is the chart on the right-hand side, you can see the number of, the market is interesting because it is, there are two parts of the market. There is one part of the market, market in aggregate is slightly above average, but within that, there are still a significant number of sectors which are attractively priced and are trading below the 10-year average valuations. And what are those sectors? Those include PSU banks, metals, private banks, pharma, and utilities. Those are segments which are still below their long-term averages. Those which are a little bit more on the expensive side include consumer staples and consumer discretionary. Now, at the end of the day, while this is a sector perspective, it is important to keep in mind that we follow a stock-specific approach. Because at the end of the day, even in a sector which is expensive, like IT services, which is about 15% above its average, you can still pick and choose individual companies which are trading at reasonable valuations where the outlook is quite positive. So I think it is important not only to look at it from a sector standpoint, but more importantly, to look at things from a stock perspective. We now move to mid caps, small caps. So we spoke about large caps being at a 10% premium. Mid caps is a little bit different. Mid caps trade at about a 30% premium to the historical average. So certainly compared to large caps, mid caps are more expensive. When you look at small caps, that doesn't hold true. So there is a common understanding or thought that mid caps, small caps are expensive and large caps are relatively less expensive. The distinction we are making here is that yes, while mid caps are on the expensive side, it is not true for small caps. When you look at the small cap PE multiple, the small cap PE multiple today is about 16.5 times. That compares to an average of about 15. So again, it's at about a 10%, 10-12% premium. So small caps and large caps both trade at a 10-12% premium versus mid caps, which trade at a 30% premium. And always keep in mind that valuation excess tends to act as a drag on returns. So the more expensive the markets are, the little bit more concerned we should be But having said that, we are not in a market environment where the market is phenomenally expensive. We're just about 10, 12% premium when you look at large caps and when you look at small caps. We have shown here, we get a lot of questions in terms of FI behavior and participation and so on. And hence we thought we'd address it upfront. And I have about 2, 3, 4 minutes before we get to Q&A. But what we see here is FI holdings have dropped to a multi-year low. So FI holdings, which had peaked out at 24, 25%, have now come down to 21, 22%. And in fact, as a percentage of their assets under management, this has been the largest selling we have seen by FIs in many years. So as most people know, the last year was a year in which FIs sold and DIIs bought. Now, the interesting thing is that FI holding is at a multi-year low, and DI investments are likely to continue simply because we are seeing more retail participation. And ownership of equities in India still remains quite low. Let us sum it up with a look at global valuations. So US markets have obviously corrected quite meaningfully from the top. So what we have here is the S&P 500. It is now trading close to its historical average. Europe, on the other hand, has fallen much more sharply because of concerns on growth and energy and so on. And Europe actually trades at valuations close to bottom levels. So this is close to the lowest valuations that we've seen in Europe for the last 10 years. So valuations in that sense in Europe are very attractive. When you look at Asia and emerging markets, they trade slightly below their long-term average. So I think a few takeaways from this. The first takeaway is that while Europe may be struggling from an economic perspective, that seems to be more than captured in the price because valuations are trading at a 10-year low. So I think that's one important takeaway. The second is that what has happened is global markets have corrected downwards. India has moved up, and hence India's premium to global markets, and that is what we have on the bottom chart here, is India's relative valuations compared to global markets have moved up. Fortunately, from the Indian investor perspective, most investors tend to invest largely within India. So whether global markets tend to perform better or worse, we as Indian investors are much more focused on the Indian outlook. And from an Indian outlook perspective, like we spoke about earlier, GDP growth remains benign. India stands out from a growth perspective. Valuations, while they may be a little bit expensive, are not phenomenally expensive. And hence, while we can bring down our return expectations by 1% or so, I think the long-term outlook continues to be quite constructive from an India standpoint. So that was the last slide. We have here a brief introduction to our team. I'm not going to run through this person by person, but I think the point that we wanted to highlight is we have an extremely capable and experienced research team. Across fund managers and analysts, we typically have an experience of 15 to 20 years, and we have more than 350 years of accumulated experience.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.